Futures are down. It could mean the first monthly loss for the S&P in 7 months. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, results from Microsoft and Meta fail to impress investors, and it raises the stakes for earnings reports today from Apple and Amazon.
Meanwhile, this morning, we got a wave of earnings reports from other sectors, including Peloton. It's tapped Ford executive Peter Stern as its new CEO.
Plus, more economic data to digest ahead of tomorrow's big jobs report and next week's Fed decision. We'll break down all of that data in just a few moments, but let's take a look at where markets are trading on this Halloween. I assume that's why Matt grew hair briefly, but you take a look at the setup right now, it's pretty scary. You have the S&P 500 down about 0.7%. Of course, we had Meta, we had Microsoft after the bell. Disappointing last night. You can see that reflected in the NASDAQ 100, down about 0.8%. At least quiet in the bond market, of course. We got some really interesting economic data in PCE, in claims, in spending this morning. You add it all together, the 10-year Treasury yield, Matt, currently at about 4.29%.
It was just a wig.
It was just a wig?
It's the magic of
television.
television.
Very scary.
Take a look at this chart here. I was just saying, you know, we've had 6 months of gains in a row on the S&P 500, but we're about 9/10 away from a loss for this month on the last day of trading. Happy Halloween.
Oh, happy indeed. We have some more scary news when we look at earnings season as well. Let's look at what's happening pre-market. You have Uber down 7% pre-market. They had reported, of course, they delivered record operating profit, but the forecast was short of expectations. Also looking at Estee Lauder pre-market, down 23%. Whoa. Guidance was uncertain over a new CEO, weak demand in China. There's a lot to say about that stock right now as it transitions to a new turnaround. Peloton also turning around, announcing a Ford executive here, Peter Stern. He's going to take over as CEO in 2025, and people like it. Peloton's up almost 19% pre-market. Also looking here at Robinhood, down more than 9%. They failed to meet high expectations in the third quarter. They blamed a customer promotion that required the firm to offset a portion of revenue. Here's the big story. Meta, Microsoft down on growth concerns. They're spending big on AI. Meta now down 1.4%. Microsoft even more so, down 3.8% pre-market, Matt.
Yeah, I'm obsessed with the spending plans of these companies. I mean, Meta is going to spend $100 billion this year, or near as damn it to it. And Microsoft spent more on CapEx in the last quarter than it did in the whole year pre-COVID for property and equipment. So they're really ramping up spending, and they would spend more if they could. They just can't get enough GPUs.
And also, it's not sure that investors are really signed on to that spending, especially in Meta. I mean, there's a real scrutiny of what they're spending money on. And it's interesting. You take a look at the read-through into NVIDIA. Shares off slightly this morning. You think about its 2 biggest customers, at least according to SPLC, the function on the Bloomberg terminal. It's Microsoft, and then it's Meta. And both of these reports being met with some skepticism.
And maybe deservedly so. You have Meta up almost 70% this year already. So valuations at the levels they had been. If you were talking about Alphabet, we were talking about how they were cheaper already because of antitrust concerns. But now we're getting into high flyer territory. So it just is going to take more to beat.
All right, let's dive into these tech results with Bloomberg Technology co-host Ed Ludlow joining us now from San Francisco. And Ed, I mean, we had some big reports last night. We have some big reports after the bell, of course. But let's start with Microsoft. Let's start with Meta. And with Meta, it's interesting. You have these AI losses. Of course, sales narrowly beat. But then you think of Reality Labs, for example, a $4.4 billion loss. And of course, Mark Zuckerberg said they plan to keep on spending.
Yeah, I think you guys are right to frame it that the bar was high anyway going in. But the calculus is the same that it's been for the past several quarters, which is we knew that there would be a capital expenditure guide, that CapEx will increase. And Matt makes an interesting observation that not only is Microsoft spending at that level, as is Meta, but Microsoft is telling us they're actually supply constrained. They don't have enough data center capacity to power or compute the demand for their AI products. And so where the market's reacted negatively is actually kind of saying, well, hold on, we understand that part of the formula. What's a little bit worrying in the forward-looking guidance is that your bread and butter businesses, your core businesses, which in Meta's case is advertising and Microsoft's case is kind of selling software, aren't growing to the levels, or in Azure case, cloud, growing to the levels that we expect to support the spending you're telling us you're going to do.
Investors are really behind this, though, Ed. I mean, let's not make too much about today's drop. Microsoft has, tripled in the past 5 years, and Meta is up 67% this year to date. So investors are all in on these companies, even if they're taking a little off the table today.
Yeah, and in both cases, the market reaction is somewhat muted, right? Think about the post-earnings swings we have seen over the last 18 months or so. Meta's really interesting because it's a return to the same story, which is looking at the losses in the Reality Labs unit. That's the unit that largely accounts for the hardware, like the Ray-Ban glasses, like the AR, VR headsets, that are the physical manifestation of how they hope AI will be used. They've been punished over and over again in recent years for those losses, but then investors seem to put it to one side. Now we're back to focusing on those losses, but again with the added information that the core ad business, at least in the final 3 months of this year, won't grow at the same pace that the market had hoped.
Well, just to dig in a little bit more on that point, clearly investors are behind this round of spending. But Ed, remember the year of efficiency for Meta? There was a time, 2022, for example, where investors were, again, pretty skeptical. Shares were down 64% that year.
Yeah, and also Meta has done cuts recently, right, in terms of headcount reduction. They have a complicated business. What is Meta? It is no longer just a social media company. It's investing heavily in AI in the context of software, training large language models, and getting the talent needed to do it. It's also a hardware company. And one thing that jumped out at me that was very interesting is that these Ray-Ban glasses, which I've been writing about, the success of those has been a big surprise. But like all companies, Meta's finding it now needs to be nimble and reallocate resource to areas that are growing while still saying, look, we're going to spend. Matt, one thing that you said, $100 billion this year, they actually did lower slightly the range of expenses from 99 billion at the top end to 98 billion, but told us that that will grow in 2025. But you're completely right to point out that this is the severity or scale of the spend to support all of those business lines.
I did say near as damn it to it. That's a British expression for you, Ed, that I use.
Damn it, darn it. Ed, hey, listen, the next 24 hours are also pretty intense. Amazon, Apple, what can we take from the results we've seen already to read through, especially as there's such a large focus on these next two companies when it comes to the consumer? It's got a little texture to it that's a little different.
Yes, although Amazon will be held to the same standard as Alphabet and Microsoft, right? Because Amazon is the market leader in cloud. And both Google and Microsoft Azure basically told us they took market share in the quarter, which logically would follow, therefore, Amazon ceded market share to them. And then there is the consumer exposure, particularly in an election period, that Amazon might tell us about the health of that consumer. Economic data, as you guys, I'm sure, will discuss next, is kind of astounding at the moment. And then on Apple, it's just about the iPhone. iPhone 16 in China, it's very simple. But you will note that they released the latest iOS 18.1 in the past week, which brings Apple Intelligence finally to market in a sort of thin beta way, and that will be interesting to learn sort of how the path forward to monetization on that is planned out for Apple.
It's almost as if you lined the show, Ed. It's too much. You're a threat.
I was once a producer.
Anchor, producer, Ed Ludlow. We welcome you, or we thank you, I should say, for joining us. Welcome you back anytime, of course. Tune in to Ed's special coverage of Intel earnings, including an interview with the CEO, Pat Gelsinger, at 6 p.m. Eastern tonight. I know Katie's not going to miss that. An iconic American company.
It is, going
in
through
its downfall.
A real spiral here.
All right, let's get to the economic data, because as Ed mentioned, it is, amazing in the fact that the Fed is cutting right now, and yet inflation on the core is rising in the measure that the Fed watches, and the jobs market looks strong in terms of initial jobless claims. So for no reason at all, the Fed's going to continue to cut. Michael McKee, our politics and policy editor.
We're going to set up that debate. Katie and I have a deal. She did the markets off the top, called them scary. She gets the tricks. I get the treats because the numbers are all pretty good today. We did see income and spending rise more than anticipated, and it suggests Americans are still hanging in there. I don't know if it was all the candy people were stocking up on for Halloween, but incomes rise by 0.3% and spending by 0.5%. More than anticipated, and the savings rate stays somewhat elevated. Then you look at the inflation side of the Fed's mandate. This is what Matt's talking about. The PCE headline comes in up 0.1%. The core comes in up 0.1%. But the year-over-year numbers pretty much stay the same, or in the terms of the headline, go down to 2.1. Remember, the Fed's target is 2.0. Employment cost index, the third number out today, relatively tame, up just 0.8%. The wages and salaries portion up 0.8%, which feeds into that income number and the income and spending. And then, of course, with the jobless claims numbers, 216,000. That's the best since early this year. And it does show that companies are still hanging on to workers. Doesn't say anything about what's going to happen tomorrow, though. So we still have to be here. Everybody be here at 8:30 a.m. tomorrow.
Well, how much can tomorrow move the needle? You're not seeing that much movement in the bond market off the heels of this data. You're not seeing anything in Fed futures either. It's still less than 1 basis point really priced in, or less than 1 Fed rate cut. You have 23 basis points really still baked in. If you don't see that November cut, does it matter?
It probably doesn't matter. And if we get a strong number tomorrow, then we're going to see some movement in the futures about November, but probably more December. People will say the Fed's already on track for November. They will probably cut, but there will be questions.
This Fed's not data dependent anymore. Remember when they were data dependent?
No.
For most of your life, I think, they've been data dependent. And right now, we're just looking month by month. They don't know what is happening, but they have a sort of rough plan to bring down interest rates. We'll see if it carries through, if the data support it.
All right, Mike McKee, happy Halloween.
Or if the data don't.
Yeah.
Here's what I'm going to say. I'll make a bet with you on this show. Even if the data are strong for the labor market and inflation continues to come up, as it has, the Fed is still going to cut in November.
Well, it depends. You got to take a look at the underlying reasons for the core to go up. Fed doesn't think it's because the economy is strong. It's just residual. But we'll see.
All right, spoken like
trick
a
or treat tonight, Matt.
A true economist.
Matt, go to Jay Powell's house, hold out your little bag, and say, rate cut or no rate cut?
Hopefully wearing that wig. I don't know why you took it off.
You should have kept it.
Did you like the look?
It was
appropriate.
A little spooky, you know.
Yeah.
But
well,
we were both terrified.
It is Halloween. All right, coming up, we'll keep the party going. Invesco's Brian Levitt on why he thinks concerns around U.S. debt are overstated. That conversation coming up next. This is Bloomberg.
Let's get now to high interest, a look at what's making headlines around the world. The Bank of Japan has kept its benchmark interest rate unchanged, but Governor Ueda hinted at a possible rate hike in the coming months if prices and the economy stay in line with forecasts. The yen did strengthen on his comments, but the dollar has been hella strong. Actually, we had, I think, the best month in 2 years for the U.S. dollar. China's economy is showing signs of stability after stimulus measures. Factory activity unexpectedly expanded in October after 5 months of contraction. PMI data also came in higher than expected for China. And the LA Dodgers are the world champions once again. After falling behind 5-0 in Game 5, a series of defensive mistakes by the Yanks opened the door for an LA comeback. It's the team's 8th World Series ring and the first for superstar Shohei Ohtani. Freddie Freeman was named Series MVP after a record-breaking performance at the plate. I obviously didn't watch because it's baseball, Katie.
It's baseball, yeah. I think a lot of people are very sad this morning. But let's take a look at the market right now, because that also is a pretty sad picture. You have the S&P 500 down about 0.6% pre-market. Disappointment on the earnings stage last night from Meta and Microsoft. We'll see what Apple and Amazon have to bring us. It would be a big boon for the NASDAQ 100 if they managed to surprise, because the NASDAQ 100 currently only off by about 0.7%. We're not too far from those all-time highs, but they certainly feel far at this moment. And then you take a look at the small caps holding up relatively well, at least at this exact moment in the pre-market. The Russell 2000 off by about just 0.1%.
Thanks, Katie. We're going to get more into these markets now with Invesco's global market strategist, Brian Levitt. You see the move already when you look at these two that reported overnight. Of course, it's a little sour, but you have the Mag 7 total return index still up almost 50% year to date. I mean, are some of these kind of losses warranted? Or are investors just taking some chips off the table, particularly before an election?
Yeah, I don't know if it has to do particularly with the election. I think it's more that, expectations get to a certain level and, at some point it becomes a little bit difficult. And the market has to look at multi-year periods, right? These are big investments these companies are making, and it'll take time before we recognize how that accrues to their business or how it accrues to the global economy. So, intermediate, long term, I'd still be very confident on these businesses. They have moats, they have advantages. Quarter to quarter, you'll get a little, hiccups. But remember, these are businesses that are, growing.
These are stocks that have almost all at least tripled.
Yeah.
Essentially. I'm talking about the whole Mag 7 in the last 5 years, while the S&P has just barely doubled. You had to reinvest your dividends to get that. Is it still a buying opportunity when we see a drop like today? I mean, are they still going to be powered higher in the long run?
I think they are. I think that these are businesses that are, again, they have these moats, they have long-term growth potential, so I think investors need to own them over the long term. What becomes more interesting in the near term is, of course, how concentrated these markets are. If the economy is as resilient as it appears, inflation's in the comfort zone, rates come down, you start to see more of that broadening out, and you've seen a bit of it over the last few months. So that's what investors should be looking towards. How do the other 493 do? How does the mid-cap index do? And it's a good backdrop for broadening of market participation.
Well, let's knit together what we're learning from corporate America and the Mag 7 with what we're learning about the economy. Of course, we had a raft of data out this morning in the 8 a.m. hour. Core PCE coming in a little bit hot on that year-over-year basis. Spending picking up. You had claims coming in lower than expected. Seems like all systems go in the economy. Is this a Fed that should cut?
I do agree it's all systems go, and we've been joking that it might not even be Goldilocks, it might be platinum locks. I don't know if that's too promissory, but it's quite good. Now, if you think about the Federal Reserve, I mean, you have a funds rate that had been 5.25 to 5.5. That's pretty tight for a world in which inflation is 2. So I think it's appropriate to bring rates down. The good news is they're not dropping.
Dude, inflation is 2, like, in the dreams of the Biden White House. I mean, inflation is not 2%.
Well, it's the change. It's the, the Fed needs price stability, right? The Americans look at the cost of living. We all know the cost of living has gone up significantly. That's not, the Fed needs price stability so people understand what the dollar in their pocket is worth, so they can make plans, businesses can make plans. So, politically, I think for Biden and Harris, it's been a challenge to explain that. We had a high cost of living, but we brought the rate of inflation down. I'll let the electorate decide that. But the change in inflation is very benign, and that's the type of thing that the market's going to look for because it allows the Fed to lower rates.
I just keep wondering if you look at WIRP, I feel like the terminal rate's about 3.5%, right? I'm not very good at navigating WIRP, the WIRP screen, but
WIRP, World Interest Rate Probabilities.
And that's where the terminal rate would be. Like, is that
it's the neutral rate higher?
Do we need to go that low?
Going to drift back higher. All of this does tie into what we'll see next week. We are 3 trading days away from that U.S. election. There are a lot of concerns about the spending plans. Don't want to talk about the debt for the first time today, but I do want to talk about the trade because you have seen a lot of investors take chips off the table headed into next Tuesday, but you have seen a serious risk-on appetite in the Trump trades. So how do you think about what you do until we get some more clarity around the direction of travel?
Yeah, the reality is that people like to think about these Trump trades, Harris trades, Republican trades, Democrat trades in the weeks leading up. And I view those more as getting a sense of who is going to win rather than what's necessarily going to outperform over the coming years. You know, if you and I had sat here in November 2016, I think we all would have thought traditional energy would outperform under Trump. Turns out clean energy outperformed. If we had sat here in 2020, we would have thought clean energy would outperform. Turns out traditional energy outperformed under Biden. So it really comes down to more, when you think about sectors or industries, market nuance, direction of the economy, what the Fed is going to do. And so I think regardless of who wins on Tuesday or whenever we find out, the direction of the economy looks like things are going to pick up a bit. And the Federal Reserve is going to slowly bring rates down to that neutral level. We could debate where it is, but that's where we're heading. So that should be a good backdrop for risk assets, irrespective of who wins.
All right, Brian, it's great to speak with you. Really appreciate you stopping by. Of course, it is a busy week. Great to get some of your insights. That is Brian Levitt from Invesco. And coming up, Starbucks' new CEO brewing up a new plan to turn the company around. More on Brian Niccol's plan next. This is Bloomberg. All right, it's time now for Social Climbers. Companies making waves this morning. And first up, Etsy rising in pre-market trading on a revenue beat. The online marketplace made more on commissions, and its gifting feature launched earlier this year, also gaining popularity. Etsy also approved a $1 billion stock buyback program. You can see shares currently higher by 8% or so. Next up, eBay. It's dropping after projecting holiday season sales that fell short of estimates. Now, in an effort to stem its eroding market share, eBay has been focusing on narrow categories such as car parts, luxury goods, collectibles, and refurbished appliances, not yet bearing fruit here. And finally, Starbucks. The new CEO, Brian Niccol, plans to reboot the company by focusing on coffee. That's surprising, improving service times and revising the staffing model. Niccol aims to reduce drink customization, trim the food and beverage menu, and also bring back touches like a condiment bar to make the Starbucks experience feel less like fast food. Starbucks shares currently off by about 0.2%. Meanwhile, a quick check on futures here on the index level. You can see we are down on the day, currently off by about 7 to 8% on your big benchmark indexes. The small caps currently down by about 0.1%. The opening bell is up next. This is Bloomberg.
Happy Halloween. It's the last trading day of the month, and futures are down. We just got about 20 seconds to go until the start of the cash trade. You can see futures are off 0.75% on the S&P. NASDAQ futures off even more. This because Meta and Microsoft spooked people a little bit with their spending plans yesterday. They're spending as much as they can, and they want to spend even more. The opening bell at the New York Stock Exchange, fans for the cure, ringing that bell. Doesn't say the cure to what, but I'm sure it's important. And down at the NASDAQ, you've got Tridentity. You know, I never prepare for these opening bell ceremonies because they really don't matter, but I think they're interesting and good visuals. Katie, if we fall more than, I think, 0.9% today, then we have a loss for October, and it'll be the first loss for a month in the last 7. How does it look?
Yeah, well, first of all, no one could ever tell that you don't prepare for those segments. And honestly, Matt, it looks pretty scary right now. Of course, some monster spend plans from the big tech names reporting yesterday. Like you said, spooking markets on this Halloween. You can see on the S&P 500 down about 0.8% in the first 47 seconds of trading. The NASDAQ 100 really taking a beating. Of course, we had a big drop in the regular session today, and that momentum to the downside really building this morning. Currently down about 0.9% 0.2%. Of course, we have some big names after the bell in Apple, in Amazon, so we'll continue to watch that one. Small caps, surprisingly, the resilient area of the market today. The Russell 2000 only off by about 0.1%, but of course, it's been a very rocky month across all size tiers. Now, some stocks to watch, of course, as we get deeper and deeper into earnings season. Let's take a look at Uber, reporting weaker than expected bookings for the third quarter, issuing a muted forecast for the holiday season. Not what investors wanted to hear. You can see Uber shares currently off by about 7%, Sonali.
Sky high expectations over there. Sky high expectations over here as well. Robinhood failing to meet expectations as well from investors. They had blamed consumer promotion that required the firm to offset a portion of revenue. Robinhood shares now down a little more than 8%, was a little more than 9%. A lot of sour attitudes in the market this morning, Matt.
Yeah, a little bit of a letdown in terms of, I guess, the reports that we got out from Microsoft and Meta. They are weighing, obviously, on the broader index, on the S&P, as well as the NASDAQ. Profit growth from AI is a concern, I think, for those companies. For example, AI cloud usage is only 12% at Azure. I would have thought it was like at least 50 by now. Let's take a closer look at the stocks with Bloomberg's Abigail Doolittle. Abby?
Well, we do have some pain for both Meta and Microsoft, as you were talking about, but playing it forward to Apple and Amazon. These two companies, of course, report after the bell. Earnings, big tech earnings so far have been a bit mixed, given the fact that you had Netflix, Tesla, and Alphabet good. AMD, not exactly big tech, but not so great. And then Meta and Microsoft, as you were mentioning, lower. Apple, the focus will be on the soft uptake of the iPhone 16, and then Amazon cloud. Speaking of the cloud, that is one issue for both Meta and more so really for Microsoft. Meta, they put up a good quarter, but those costs, those spending plans that you were talking about earlier. And then Microsoft, they put up an okay quarter, certainly not a blowout, not great across different metrics, one of them being that cloud, that Azure product. If you take a look at it, you can see that in recent quarters, the growth has been going from 30% to 35%. In the quarter that was just reported, 34%, so a little bit lower in sequential decline. The estimate for the upcoming quarter, the December quarter, between 30 to 32%. So investors a little bit negative on that. Now, relative to the Mag 7 and the markets, if we take a look at what's going on here, this is the market cap for the Magnificent Seven. So you can see it's been a very good year at the highs, about 17 trillion, now making the way back. Something I would say, though, Katie, this is a range, and if the market cap were to decline back down toward the bottom, that could actually be some sort of a pattern that would take the overall complex lower. But let's wait to see if it can cross above that threshold of 17 trillion, or are we going to go back down into the range? Apple and Amazon could be important.
Yeah, we'll definitely get some more clarity to that point after the bell today. Abigail Doolittle, thank you so much. We also do want to check in on Estee Lauder because we're taking a look at the biggest drop on record. That's after the company suspended guidance as it sees weakness in China. We've heard that before. And the new CEO working on a turnaround, certainly a big job on his hands. Shares off by about 26%.
The jacket kind of reminds me of the Estee Lauder ladies that give you the makeup at Bloomberg.
Because I'm Dr. Greifeld in this jacket, as you keep telling me. Yeah, I don't know. Maybe they should start selling these jackets.
25% is a big drop.
It's an owie, I would say.
Hacking off a quarter of the company's market
cap. Of course,
cap.
it's sort of like lowering the bar for the new CEO, you know?
Oh, that's a good point.
Expectations are reset. It'll be interesting to follow that one, but of course we are following tech very closely. And let's keep our focus on with Lei Chu. She is Bernstein's CIO for Thematic Innovation Equities, joining us on set. Great to see you in person.
Oh, good to see you too. Thank you for having me here.
So big tech, of course, the most urgent question in markets, at least at this moment, of course, seems to be whether that AI spend that we're seeing from the Magnificent Seven is actually bearing fruit. We had some good news, it seemed, with Alphabet, of course, that seemed to actually produce some results. Now that question kind of back in the market right now. What's your take?
Well, we do believe that CapEx is going up and will likely continue to go up for a sustainable period of time. But we also think that there has been a lot of question on ROI, and we're actually seeing ROI at the early stages from AI, whether it be from Alphabet, Microsoft, or from Meta yesterday. What we are seeing is an inflection of incremental spend and the incremental return that you get from it. We're seeing stronger revenue from cloud-based infrastructure spend. We're seeing better engagement, better targeting, and better advertising revenue.
But it's not that much, right? 12% for Microsoft of the cloud spend was AI. Last quarter, it was 11%. to justify the gains of the stock. Shouldn't that be rising a lot faster?
I think we would always like to see everything in a linear increase at a very fast pace, but bear in mind, these are very large companies. And then also, we just started the spending, right? And then when you look at the AI spend, part of it is on the physical infrastructure side. If anything, when you look at the CapEx spending and look where it's going, it's actually has been more on the data center, power infrastructure, et cetera, to put everything in place before we actually see the digital infrastructure spend. So, yes, we would all like to see that great set of results, but also patience is a virtue sometimes.
Patience. We need to work on that.
What role does valuation play at this juncture in your decision-making process? Because we have seen these really significant run-ups in a lot of the stocks we're talking about today. But when you spend that incremental dollar, do you look outside of the Mag 7, or do you keep deploying knowing that you're going to get that ROI?
We actually think the market will, and then we believe investors should increasingly scrutinize and then see whether the incremental spend will generate ROI. And that's what we're in the process of doing right now. We are seeing our early results from, mostly the market has been focused on Mag 7, but we're also seeing, at the end of the day, it's really about pricing power and about incremental revenue and profits. And when you're in the current environment, there's demand-supply imbalance on the infrastructure build. You can actually find alpha opportunities outside just the Mag 7. Not saying they're not good, but you're seeing greater return opportunity outside that as well.
You mentioned the infrastructure bill. Does the election change your investment case? I mean, if one side wins or the other, do you have to rebalance your portfolio?
That's the beauty of tech. I think regardless of what the election result is, what we are seeing in the current environment doesn't really change, whether it be reshoring or be the demographic aging and the challenges that pose. Really, tech is here. That's going to produce the solution, actually, to have better efficiency, better productivity. And tech, by definition, innovation is deflationary.
Right, but these big, possibly monopolistic, what do we call them? Hyperscalers.
Yeah, there you go.
They face regulatory concerns, don't they? From this administration and then potentially from a Harris administration as well.
Well, we're not here to call the regulatory outcome. It's really binary, and we certainly don't have an edge on that. What we really focus on is looking at the business. And one thing I would highlight here is for the Mag 7, even among themselves, so we talk about CapEx, the reason that everyone is spending is AI it's a strategy, is as defensive as it is offensive, right? It gives them the opportunity to compete with each other. And it also means that they have to defend their competitive mode because AI lowers entry barriers.
Right.
So that's why we believe CapEx is here to stay. And we believe everybody is scrutinizing what they can get from it.
Well, to oversimplify your point, it sounds like what you're saying, in a sense, is that big tech could be considered politics proof. Something I also hear from investors is that, in a way, it's macro proof as well. You know, you think about the Fed's key interest rates, where, of course, terminal, neutral, et cetera, will eventually be. I mean, some of these companies, Amazon is probably going to make money in any environment. And as we also hurdle ahead towards a Fed meeting, I mean, how do you marry in, of course, monetary policy with your analysis of these big tech names?
Well, valuation is always part of the equation. We certainly look at the valuation in relation to interest rate and then the discount rate. But that said, it is most important to focus on the fundamentals and to see we're spending a lot of money, who's going to be the ultimate winner, and who's going to make the most money. It's always about the long-term profit pool, the incremental profit pool that we can get.
Lei, we thank you so much for joining us here on set. That is AllianceBernstein's Lei Chu. And coming up, another CEO shakeup at Peloton. We're going to talk about that on its earnings. You're seeing the stock up more than 16% into the market open. This is an interesting turnaround story, guys. It's coming up next.
Volatile. Very volatile market. Up 25, down 25. Stay with us. This is Bloomberg.
Welcome back to Open Interest. A check on the stock market right now. Losses deepening. You can see the S&P 500 off by about 0.8%. Then you take a look at your big tech index. That's really where the pain is concentrated. The Nasdaq 100 off by about 1.2%. Small caps holding up, at least for right now. The Russell 2000 off by about just 0.1%. Meanwhile, it's time for our top calls. Some of the analyst action in focus this morning. And first up, Bernstein issuing a rare bearish call on ARM, cutting its view to underperform with a $100 price target. The analyst says that she's struggling to find upside given the stock's valuation. That valuation coming down right now, shares off by about 6%. Next up, Argus Research downgrading Supermicro to hold. This, of course, comes after Ernst & Young resigned as the company's auditor, citing concerns about governance and transparency. Big down day yesterday, big down day today, shares off 12%. And finally, we have Estée Lauder's. Its bleak update prompting at least two firms to downgrade their ratings on the stock. Stifel cut it to a hold. You have Citi cutting to neutral. Estée Lauder, of course, pulled its guidance for the year, citing uncertainty over a new CEO and weak demand in China, Matt.
All right, let's check on Peloton shares right now. The fitness brand reaffirming its forecast, and the company also announcing that Peter Stern, currently a president of Ford Integrated Services, will become Peloton CEO starting in, January 1st, I think is the start date. Let's discuss with Bloomberg Intelligence analyst Geetha Ranganathan. Geetha, this guy just got to Ford. He was supposed to boost their software sales, and now he's going to go to Peloton. He was at Apple. Tell us a little bit about Peter Stern and what he can do for the what is it called? Stationary cycling company.
There you go.
Yeah, thanks, Matt. So it looks like Peter Stern does, of course, have a pretty good track record. As you said, he comes from Apple. He was the co-founder of Apple Fitness. So I think that kind of gives him a lot of credibility. And before Ford and Apple, he was at Time Warner Cable. So I think, he kind of can cover a lot of different bases here, whether it's the intersection of hardware, software, running a subscription services business, which is exactly what Peloton is. So I think he definitely brings a strong track record. And it looks like he's a great fitness enthusiast himself. I mean, he's the son of a fitness instructor. So, it definitely it seems like a pretty good match. We'll have to wait and see what happens.
Yeah, you think about what he was hired to do at Ford just last year, running their newly created technology-focused division, focusing on harnessing the growth in car software services. Like you said, of course, Peloton trying to strategically shift its focus from being that hardware-heavy sort of company to being really a high-margin subscription revenue business. This was something that Barry McCarthy was trying to do as well, really put the mobile app at the center of the business.
Yes, he was trying to do that. He had a pretty good track record, too, coming from both Spotify and Netflix. But Peloton has really, suffered from really a host of different challenges when Barry McCarthy took over. I mean, of course, they had a problem of, very high levels of inventory. The cost structure was not aligned, with the demand. Demand was falling after the pull forward from the pandemic. So there were really many, many different things that had to be done. And so what has happened after Barry McCarthy left is they have this co-CEO structure, and the two interim CEOs, while it has been a stopgap arrangement, have really delivered in terms of a focus on cost cutting and a focus on profitability, and they've really kind of shifted that narrative. Now with the new CEO, what we really need is kind of this articulation of what his strategic vision is for the brand, for the product, whether they want to go into new modalities. And one always has to wonder, kind of just given his background in Apple, Katie, whether there will be an ultimate M&A play here.
Speaking of M&A, you think about just how far this company has come from its highs. This was trading at $167 per share in 2021, and now we're trading at less than $8, even with the spike you're seeing today. And so, how much more upside is there for Peloton? Why wouldn't a buyer just swoop in right now while it's still so cheap, Geetha? Because there's upside starting to show in the performance.
Yeah, I mean, Sonali, David Einhorn seems to think that it is severely undervalued, and he does make a few good points. I mean, this company does have a very, very loyal customer base. There's no doubt about that. Churn is very, very low, just kind of given the business, and they have some of the best content. They are absolutely the best connected fitness experience. But there have been, the problems in terms of a high debt load, which they're again working to correct. The problem with, a very a bulky cost structure, which again they're right sizing. Yeah, I mean, M&A has always kind of been this big question for Peloton, and we'll have to see what happens right now. I mean, Apple has always been kind of this big rumored name, but as we know, Apple's always been shy about
Peloton
going
could buy
after.
Apple? That would be insane.
Yeah.
No, Geetha, I mean, the idea is it's only a $3 billion company, right, Peloton?
Right,
so
right.
Are they looking for a suitor? Is that the feeling in the market?
There were some rumors, Matt, that they were kind of approaching private equity, and that's kind of where the whole cost cut and the focus on free cash flow and EBITDA kind of played into that. But again, those rumors kind of died out. But with David Einhorn kind of pounding the table, you have this new CEO. A lot of things could happen.
Geetha, we thank you so very much for your time. That is Geetha Ranganathan from Bloomberg Intelligence. You may remember we were talking about that M&A maybe just a couple months ago. It was this year that we were talking about Peloton M&A, but there was a lot of skepticism around it then too. There was private equity around the hoop. Could a big tech company buy it and boost their kind of physical presence here?
I think the fact that they're appointing this new CEO suggests that they still want to stay in the fight. And it's interesting, I mean, listening to Geetha, it's not necessarily a question of strategy, because Barry McCarthy also wanted to get away from hardware. It's really about execution here. So we'll have to see, of course, if this Ford alum can deliver.
Haverford?
No.
Ford, just regular Ford.
You know, they make cars. I'm sure you've heard of them.
But by the way, they still do the bikes, right? They have a rowing machine.
They have a rowing machine. But their fitness
treadmill.
app is really, I mean, again, it's supposed to be the centerpiece, and it's really good. I mean, just one woman's opinion. I use it for Pilates, and they're pretty decent classes.
All right.
Well, content indeed is king. Anyways, coming up, investment banking giant Lazard reporting a surge in deal making in the third quarter. A lot of optimism around money being put to work next. We're going to talk about it in the Wall Street Beat. This is Bloomberg. And it's time now for the Wall Street Beat. Today, looking at Lazard, the investment banking giant, reporting this morning before the bell. Company CEO Peter Orszag made some interesting comments on this morning's call, including one about the upcoming landscape for M&A. He said, quote, "We had not really been seeing things being put on hold until fairly recently. I do think now there are a variety of discussions where this close to an election makes sense for parties to wait and hold to see what happens." Let's take a closer look with Bloomberg's Sridhar Natarajan, because, of course, there's that kind of buildup under the surface. One question I was asking about was how much downside is there? If there isn't a change in administration, you still have Lina Khan. Does that stop those deals being put on hold?
I would say, first off, compared to where we were 2 years ago, there is a sense that irrespective of who wins, there will be a flurry of deals. There is a lot of pent-up activity, and you expect, when you listen to all the deal makers, whether it is at these boutique advisory firms or some of the larger investment banks, the sense is that there is going to be a big uptick in investment banking activity. So you do see a lot of deals coming into the market, maybe not in the fourth quarter, but at least by Q1 2025. But then that goes back to the bigger question you're asking. What is the broader outlook under a Harris administration and under a Trump administration? And, even Peter Orszag touched on this in his conversation when he talks about the idea of under a renewed Democratic administration, you can expect more continued regulatory scrutiny, which may not be there in a Trump administration, which on the face of it sounds like something that will be not great for business. But you have to go back to Trump 1.0. Yes, taxes were lower, regulators were hands-off, but business owners, private equity bosses, they also like a regime of certainty. They do not like to operate in uncertainty or policy whiplash, and that could make it tricky for deal making.
Hey, Sri, the interesting thing about this, too, as we waited for this kind of moment to arrive for deals to come back, you actually saw the banks hire fairly meaningfully in some places. For Lazard alone, they hired more than a dozen senior people in the last few months. PJT also had record deals already, even with that kind of pause. So what does this mean for pay, for hiring, for bonus season? Are you talking to a lot of happy bankers?
Well, I don't think it's time to quite uncork the champagne bottles just yet, because we're seeing a lot of increase in conversations. There are deal conversations happening, there are deals happening, but the realized fee is still a quarter or two down the road. So when you think about pay for 2024, it won't be bad, but it's not going to be blockbuster like 2021. Not that 2025 is going to be like that, but the fact that the realized fee is not at the same level, despite all of these banks. Lazard this morning posting a 39% increase in financial advisory revenue, you still sense that they're all well below their long-term averages, and they want to meet that first, then exceed that, then think about rewarding their bankers lavishly.
They got to get paid now in case taxes go up bigly in the next regime. Okay, Sri, thanks so much for joining us. Bloomberg Sridhar Natarajan talking to us about M&A, the boutiques, the big banks as well. Coming up in the next hour, we're going to talk to Brooke May on markets. Will Power is going to talk to us about Apple earnings, Apple and Amazon coming out tonight. Chris Swift discusses the insurance industry following the recent natural disasters that we've seen. So a big lineup. Stay with us for the 10 o'clock hour. It's the last trading day of the month.
I know. Happy Halloween, you guys. This is Bloomberg.
We are 30 minutes into the last trading day of the month. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, results from Microsoft and Meta fail to impress investors. It raises the stakes for earnings reports today from Apple and Amazon.
As the cleanup continues after Hurricanes Helene and Milton, we speak to the CEO of one of the largest insurers in the country about the aftermath.
And we're on the campaign trail as Kamala Harris and Donald Trump mobilize supporters in swing states with just 5 days to go until that election. Let's get a check on markets in the meanwhile. Like Matt said, 30 minutes out from that opening bell, you can see a very spooky setup. The S&P 500 down about 1% right now, and big tech, those losses deepening, as you can see in the early trade. The Nasdaq 100 now off by about 1.8%. This is an index that was down bigly yesterday as well. We'll see, of course, what those reports after the bell hold for sentiment. And then you take a look at the 10-year yield. Of course, we got some pretty strong economic data this morning, including hotter than expected PCE that's lifting long end yields a little bit to the tune of about 2 basis points on your 10-year treasury yield, now trading at 4.32%, Matt.
You know, win or lose, Donald Trump has at least given us probably our favorite adverb
bigly
of a generation. Yeah.
I can't stop saying it.
I know, I can't either, and it's not on purpose,
No.
right? It's not a political statement at all.
Yeah.
I'm a little surprised because you're such a grammar hound as well that you love this addition to your dictionary.
Well, it's a living language.
I can't say
you know.
indices, but you could say bigly.
You can say indices. That's grammatically correct. It's just not Bloomberg style. There's a difference
You like to
here.
break the rules a little bit.
In any case, it is the biggest, I believe it's the biggest earnings day of all of earnings season. And of course, last night we had Meta and Microsoft. Tonight we have Amazon and Apple. Let's talk about big tech with Brooke May, managing partner at Evans May Wealth. Brooke, thanks so much for joining us. Happy Halloween.
Happy Halloween.
Let me first ask you about the spooky earnings we got last night. I mean, Meta wants to spend almost $100 billion. Yes, they dropped the top end of their range, but it's still a lot to sink into, in some cases, big loss-making units. Reality Labs, I think, lost $4.4 billion in the reporting quarter. And then Microsoft, they're spending as much as they can. They're supply constrained. They can't get as many GPUs as they like, but they still spent more money in this quarter than they did in an entire year before COVID on equipment and real estate. Is it all justified?
I think you can justify it. That said, there has been kind of a bifurcation in the Mag 7. I don't know that we continue to lump them together. We're seeing that there's been criticism of these companies trading at stretched valuations. And when you step back and you look at the earnings growth, you can justify the PE that these companies are trading at. And some of them are trading at growth rates in line with their PE ratio. Therefore, they're still a good value and you can enter. And if these companies are investing in the future, I would bet on Zuckerberg. You know, he has a proven track record of investing in their platform and delivering on it in the quarters to follow. So we continue to like big tech, but we don't necessarily like all of big tech. We think that you have to be selective in this environment. These aren't pigs with lipstick.
Well, Brooke, let's talk about that a little bit more. So you would bet on Mark Zuckerberg. Where would you be more selective? What parts of the tech industry are you talking about there?
Tesla, for example, it's always been a tough one for me to value. And, when you look at the multiple relative to the earnings growth rate, it does seem stretched to me. In addition to Apple, they're not growing their earnings at the same pace that they have historically. So it's another one that I would continue to buy, but I wouldn't necessarily overweight. I think that it's a good company, but there are areas where you can probably make more money going forward. And these companies have lagged the S&P 500 year to date, where we've seen NVIDIA and Amazon and Meta, Alphabet do well. So there is this bifurcation going on, and we think you need to be selective.
Well, speaking of the run-ups you've seen in the stocks as well, Meta, yes, you'd bet on it. It's up almost 70% this year, more than 65% certainly. Amazon only up 23% this year. It reports after the bell as well. Where do they fall in the story for you?
We like them both. We think that there's continued to be investment in their business, but it's going to pay off. So we would continue to buy them for our clients.
Outside of the Mag 7, Brooke, we continue to talk about this rotation and the S&P 493 starting to catch up in terms of earning anything and now earnings growth. What do you think about the rest of the market?
We're seeing a broadening of participation, like you said. Going into 2024, earnings growth expectations for big tech was up 28%, whereas the other 493 names expectations were earnings would only be up 7%. Going into 2025, we expect tech earnings to be up 17% and the other 493 names to be up about 13%. So we're seeing more participation in earnings, which is what you want. On average, weighted, we think that the earnings will be up about 15% year over year. And that takes us to about $275 in earnings on the S&P 500 next year. If you put a 21 multiple on that, you're at $57.75 on the S&P 500. And that's where we're trading today. So we think that you can justify the levels that the market's at. And just based on the trajectory, we wouldn't be surprised if we see 6,000 before the year ends.
So some really interesting context there, and talking about that broader participation that we're seeing in earnings. I'm taking a look at your notes, and you do point out that 75% of S&P 500 companies that have reported so far have beat earnings expectations. That's actually bang in line with the 10-year average of 75%. And Brooke, it feels like we're a bit spoiled at this point because average just doesn't feel very good in this market, I will say.
Oh, you're absolutely right. We saw it last quarter as well. Companies were expected to beat on earnings, on revenue, and give stellar guidance. Otherwise, they were punished. And that's what we're seeing today. And the market has sold off accordingly. So, quarter after quarter, the earnings expectations get higher. But these companies are proving that they can continue to perform in this environment. The same story isn't true, though, for revenue. When companies have reported revenue, only about 59% have beat revenue expectations, and that's actually below the 10-year average. However, if we see revenue growth this quarter, it'll be the 16th consecutive quarter of revenue growth for companies in the S&P 500. So there's a lot out there to be excited about.
Brooke, you have a long career on Wall Street, and now you're back in Indiana. I wonder about your specialization, which is living in retirement. How closely are you watching this election? What kind of a difference will it make for people living in retirement if we get a Trump administration or a Harris administration as the Fed, cuts rates?
Well, retirees tend to need fixed income. They want a regular income stream. And what we've heard out of the Trump administration is that there could be tax cuts and potentially tariffs. That could be inflationary. And with higher inflation, we'll probably see rates higher for longer, which would bode well for retirees who are on a fixed income. That said, going back historically, we've heard over and over again, regardless of who's in office, Republican or Democrat, the market performs relatively similarly. So there could be policies that impact corporate earnings or inflation, but overall, U.S. businesses figure out how to make money in all environments.
Brooke, we thank you so very much for joining us today in the thick of earnings season. That is Brooke May of Evans May. Now let's get a look at stocks moving this hour, of which there are many. Here's our Abby Doolittle.
Well, Sonali, let's take a look at a lot of these earnings movers that are certainly on the move, starting off with the shares of eBay down 7.5%. They put up an inline quarter. The stock right now not responding well, though, to the fact that the outlook disappointed. One analyst saying this has to do with the no-fee model in the UK, the worst day in more than a year. Microsoft also down on disappointing growth for the cloud in this current quarter, sequentially down from the quarters that were. NVIDIA going down with the big tech ship. And then we have Meta lower, but off of its lows. They put in an inline quarter, AI demand a little bit less clear there, and soaring costs. As for the car space, a space after Matt's own heart, Uber, although I'm not sure how often he is in Uber, given the fact that he has all these other cars to drive, down 9% right now, the worst day since October of 2022. Muted bookings in the U.S. Maybe that is Matt. Carvana, though, on the other hand, take a look at this. Absolutely soaring, up the better part of 20%. Their used car sales are doing very well and a bullish outlook. And then finally, DJT, Trump Media and Entertainment. Interesting analysis out from S3 Partners saying that if there's a short squeeze, if the former president Donald Trump were to win the election next week or when the results come out, we could see the stock go up to 60. On the other hand, if there's a loss there on the part of Donald Trump, the stock could be worthless. Today, down sharply, down about 13%.
All right, Abigail, thanks very much. Carvana, speaking of the used car seller, we're going to have Ernie Garcia, the CEO of Carvana, on your 12 o'clock noon program today.
We're going to talk to him, both of us. You know how much the stock is up this year, guys, just alone? 365%.
Wow.
It's wild.
It's incredible. And, you know, you have to wonder about how those valuations can be sustained. Are people buying that many used cars?
Well, there was a huge dip. I mean, the stock absolutely tanked when we thought they were going to go bankrupt.
The 5-year chart is a thing of beauty. It looks like a lot of those 2020, 2021 vintage frenzies that we've seen.
Yeah, absolutely. But they also spent a lot of money on an acquisition that everybody thought was going to basically drive them broke. And now it looks like that acquisition is powering them higher.
The reason they're a Wall Street darling is how much they like to borrow money. So actually, they have a pretty significant debt load as well. It's really Wall Street that helped them out of that trough that Katie was talking about here. A lot of private credit firms around the hoop. We will talk to him about how he's handling that.
Not just Wall Street, right? Moms, pops, firemen, police, teachers.
The whole country teaming up to really lift Carvana's stock. Of course, looking forward to that interview. But coming up on this program, Apple. We're going to be talking about the next big tech company to report. We'll discuss what to expect after the bell today with Will Power. He is senior research analyst over at Baird. This is Bloomberg.
Let's get out of high interest to look at what's making headlines around the world. The EU is opening an investigation into the Chinese e-commerce platform Temu. It's looking into whether the company is doing enough to combat sales of illegal products on its site, counterfeit products. If found to be in breach, Temu could be fined as much as 6% of annual revenue. And the CEO of SocGen is replacing several top managers, including the CFO, Claire Dumas. He's seeking to draw a line under a disappointing performance for the French bank's retail business. Shares jumped after results beat estimates this morning. Finally, President Joe Biden and First Lady Jill Biden hosted their final White House Halloween event on Wednesday. The First Lady dressed up as a giant panda to greet trick-or-treaters. Her costume was a reference to the National Zoo's announcement earlier this year that pandas would be returning to the nation's capital. Katie?
Matt, I gotta say, I liked your costume better. I think you should bring the wig back. That was a lot of fun. But we have to march onwards, and we have to talk about Apple because, of course, coming out with its latest results after the bell today, they're going to give investors their first peek at how the new iPhone 16, the smartwatches, and the AirPods are selling. Let's break it all down now with Baird senior research analyst Will Power. He has an outperform rating on Apple with a $240 price target. Will, it's great to have you with us. And we think about Apple Intelligence. We think about the iPhone upgrade cycle. There's a lot of bullish hopes and dreams that are pinned on those two elements. Do you think that Apple is going to deliver?
Yeah, well, good morning. Thanks for having me. Look, I think they're certainly going to deliver good results here for the September quarter. our expectation is they'll probably be in line to modest upside across iPhone and really the key categories. Of course, always a close look at the services revenue. That's now a $25 billion, quarterly number, becoming a, $100 billion annual revenue business. That'll garner attention as well. But candidly, I think, as you know, the bigger focus is going to be the December quarter commentary. And there have been some growing questions, concerns over lead times and supply chain checks as to what that could mean for December. And I'm sure we'll get into that. We're a little less concerned, tactically about that and looking longer term, but that'll quickly become the bigger focus.
Well, let's look longer term then, if we can. If you have to look around the horizon and there's so much uncertainty, then how much does a day's trade really matter?
Well, look, I mean, candidly, we're a little less concerned about, the December quarter, whether it's slightly light or slightly better, or at least the commentary around that. And again, we expect solid results in the September quarter, so that'll matter less. And, I think it's a classic case of, I think for some, it's just tough to see the forest, through the trees, and particularly as it pertains to Apple Intelligence. And really our bet over the medium to long term is that can help to start drive a better upgrade cycle for Apple iPhone over the course of the next year. That's not a one-quarter event. And I think, as we all know, Apple Intelligence has only just now started to roll out, right? The first iteration of that was just this week, 18.2, which is the next update, probably in the December timeframe. And that's when you start to get things like visual intelligence and the ChatGPT integration and image creator, where you can, make up some of your own, emojis. Those types of things we think can start to drive more buzz and really help with the upgrade cycle as we move through next year. And that's what we're really focused on is the upgrade cycle opportunity over the next 12 months or so.
Will, what kind of incremental gain versus the cost is AI going to drive at Apple? I noticed at Microsoft, AI cloud usage was 12% of overall cloud usage, which seems like a very small number to me. I'm not sure if they specified how many customers had added the co-pilots, the AI co-pilots to their Office. It's $30 extra on top of the normal Office price, but they said the adoption has been slow. Is it going to be faster at Apple?
Well, that's a really great question on a couple of fronts. From a cash flow perspective, it's interesting in that, Apple's not spending the gobs of CapEx that the other hyperscalers, Azure, AWS, and Google are to help drive AI. And so to the degree they can start to drive incremental revenue without significantly increasing CapEx, that flows through to their free cash flow and enhances their return on investments there, relative to others. Now, what they've got to prove is that the consumer adoption is there, and that's going to take time. And that really is going to show up in iPhone upgrades. And again, what we alluded to a moment ago is, we think we're on the bubble of an improved upgrade cycle. And there are two components to that. It's A, the Apple Intelligence capabilities driving more consumer interest. But B, the backdrop is, as you probably know, we're at historically low upgrade rates among the carriers, which effectively means consumers have been holding onto their phones for record long times. Right. And we think it's going to create some extra pent-up demand. But ultimately, the telltale will be consumer adoption. And that's going to take, that's still going to be a few quarters.
So maybe on the cusp of that upgrade cycle, of course, we'll get more detail tonight. I do want to talk about wearables a little bit here, because you think about the watch, the AirPods, the Vision Pro eventually. Talk to me about the competitive landscape, because just focusing on the watch, for example, and full disclosure, I wear a Garmin, but Garmin shares hit an all-time high yesterday, coming out with very strong earnings. I mean, what is the opportunity set, and how fierce is the competition to actually realize that?
Well, we don't cover Garmin, but it has been remarkably resilient. We saw that move too, and they've got some nice niches and big niches right now, outdoors and sports. But despite that, the Apple Watch has been a huge home run, as we know. I mean, they're the leading, have the leading market share, for the watch category globally, and they continue to add more health features. Our expectation is they'll continue to add more, health and fitness and other capabilities as we move over the next couple of years. The growth rates there have slowed, right? Just given where they are from the penetration, rate perspective. But it all feeds into the broader ecosystem, and then that takes you to AirPods, right? And some of the innovation they've introduced there in terms of, hearing tests and the hearing aid capabilities that the new AirPod Pro 2s enable with the software updates. And so, Our expectation is, Apple will remain in a leadership position on the wearables front. And again, it really kind of feeds into this ecosystem story, which is kind of the pillar of our bullish thesis.
Will, we thank you so much for giving us a look ahead here. That is Will Power of Baird. We're also looking at another tech name reporting after the bell. That's Intel. Investors are hoping for better news after the chipmaker stock suffered its worst rout in decades. Guys, you are looking at Intel really down more than 56% already this year. And while there are not a whole lot of fireworks expected from analysts and investors out of the report itself, clearly a company stuck with a lot of large strategic moves to make ahead of it.
Yeah, I mean, I'm obsessed with this story, paired with Boeing. I mean, you have these two American icons. I don't know how often I'll say this. Two American icons really seeing a big downfall this year. I mean, we all know the Boeing story. Intel down 56%, like you said, this year. I mean, going back to the 80s, this looks like they're on shape for their worst year on record. Of course, this is really painful for Pat Gelsinger, who Ed Ludlow will be speaking to. This is painful for the Biden administration as well. I mean, you think about all the money that the government has given to Intel.
Or wants to give to Intel.
Wants
right?
to. And if they can deliver on that, can they build those factories?
I'm really wondering that, especially important to me because my family is from Columbus, Ohio, and there's so much riding on a new factory there. It's interesting to me, if you look at Intel and Boeing over the last 5 years, both of them are down about the same amount.
Yeah.
They've lost about 60% of their total value over the last 5 years. So just to watch those two American icons, collapse, it'll be great to watch Ed's interview. Definitely tune in for that at 6 p.m. tonight. Ed Ludlow with Pat Gelsinger, the CEO of Intel.
There's another stock here that people are watching. Of course, a lot of not just earnings today, but a lot of CEO moves, a lot of strategic changes for Intel, for Boeing, and also for Estee Lauder. They're also now still seeing their biggest drop on record. The company has issued a bleak outlook. Oh, guys, down more than 18%. We will keep an eye on all of these changes as we go. Guys, what a time to start a show focused on companies at a time where you have this historic shakeup at the top. Stick with us. More news from the largest names in corporate America ahead. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Estee Lauder falling the most on record today. This is after the company withdrew its guidance for the fiscal year, citing uncertainty over its new CEO and weak demand in China. Next up, Peloton named Ford executive Peter Stern as its next CEO. That's sending shares soaring right now, even though Peloton also delivered a disappointing second quarter outlook. And finally, we have Amazon. It wants Alexa's new AI brain to rival ChatGPT, but technical challenges may keep it stuck in the lab until next year. Chatbots aside, Amazon is poised to report a 10% sales growth for the latest quarter. And of course, that report is coming after the market close today. And you take a look at markets right now. The setup is pretty bleak, of course, down across the board. Tiny bit of a sell-off in the bond market, of course. We'll continue to keep an eye on that. And coming up, the cleanup continues after Hurricanes Helene and Milton. We'll speak with Chris Swift. He is the CEO of the Hartford next. This is Bloomberg.
Now, Florida officials say the estimated cost of Hurricanes Helene and Milton has now exceeded $4 billion. And as of last week, over 247,000 insurance claims had been filed in the state. The crisis is creating a trying time for insurance agents across the country. And for more on how companies can prepare for the ever-changing climate that we are facing, we are now joined by Christopher Swift. He is the Hartford CEO. Matthew, I know you wanted to say it that way. I did that one for you. Anyways, Chris, thank you for joining us here in studio. This has been a really devastating bout of storms that we've seen in the country so far, and even cities you wouldn't expect being hit very hard. What does the fallout across the industry look like?
Well, from an industry's perspective, I mean, these storms are well within the industry's financial resources to respond. There's still plenty of capital, to take on risk and be deployed ultimately to protect, consumers and businesses all across the country. But the severity and the frequency of more severe storms is real. I'm not sure we're going to get the final tally of industry losses for these, two storms, but it's going to be fairly significant, but well within the capital constraints that we operate under.
How much did it affect the Hartford's earnings in the last quarter? Friday was a rough trading day. Shares were down 7% on, I think, disappointment in the commercial lines.
Yeah, there's 2 points there, Matt, I'd make. From the Hartford's perspective, we had about $250 million of pre-tax catastrophe losses. Again, relatively modest, for a company of our size. If I break down, what the Helene impact was, it was about $105 million. Mostly personal lines, think homeowners and autos issue. And then we guided to what we thought Milton would be in the fourth quarter when we report, and that's in the 65 to 110 million range. And that's going to be more of a commercial lines event and less, personal lines for us.
Well, I'm glad you brought up auto because, of course, the affordability of home insurance is definitely top of mind, broadly speaking, in these disaster-prone areas. But what is the impact of these natural disasters on auto insurance, for example?
Yeah, as I said, with Helene, when there's water and flooding involved with cars, they tend to be totaled. You can't repair them. And there are certain jurisdictions, maybe around the world, that would take sort of a flooded car. But generally, you're dealing with a total loss on a flooded car. So again, when we think about catastrophes, we model hurricanes, straight line winds, wildfires, all the perils, flooding. So we develop then catastrophe pricing for the components of auto, components of home, and then obviously anything in our commercial property book.
Has that led to the increase? I mean, auto insurance costs are high. I'm sure you've heard a lot of people complain. I'm on the phone with my auto insurer all the time, and he says, look, the price of the vehicle that we're insuring is high.
Matt, maybe you're considered risky.
Also that. There's that, too. But what's driving this incredible inflation? I mean, you're feeling it, but we're feeling it, too.
I feel it as a consumer, and we're paying more for premiums. I would say, again, in generic terms, no matter if it's auto, home, commercial, there's probably three drivers these days. One, insured values are increasing because things cost more. Homes are more valuable, cars are more valuable, used car prices, new prices. Second, broad-based inflation. You think in terms of what does it take to rebuild something, particularly of property. Lumber costs, labor costs, they're all higher. And then I would put an overlay a little bit on, we have a lot of lawyers in America that tend to get involved with claims and representing people that really extract an additional fee.
Social inflation, right?
Social inflation,
regulatory inflation, tort inflation.
Tort inflation, you could call it legal system abuse, but it's all adding up, and that's what we had to talk about in the third quarter earnings. That created a little bit of our weakness, but I think it's all fixable, obviously with good underwriting, with good rate. But the social inflation it's a tax on all of us that really needs to be addressed.
So circular in some ways as well, right? Because you're saying costs have gone up, so therefore insurance costs also go up. But insurance costs have been a very significant component of inflation as well. So where do you see the direction of travel? Because in auto in particular, there are some things that could keep costs higher, aren't there?
Well, I would say in auto, particularly the physical damage side of what we cover is actually moderating. Used cars prices are coming down. There's less of a backlog in body shops. Labor component is moderating. So there is moderation. On the liability side of auto, again, given what we just talked about, with the litigation environment, those costs to settle claims are still elevated, but are beginning to moderate. And likewise, in the homeowners product line, I do see some moderation, but it's not going to go negative. I mean, it's going to just be less of a rate increase, at least for the foreseeable future, primarily because of storm activity is more frequent and severe.
Well, I actually want to go back to social inflation because I think it's really interesting, of course, and you haven't been alone when it comes to the industry really highlighting that there's just a lot more legal issues now. And you said that this needs to be addressed. I mean, what are you proposing necessarily? And even with this issue, before it has been addressed, how are you changing your business around it?
Sure. Shakespeare had a proposal. if you recall, in Henry VI.
Remind me.
The first thing we do, let's kill all the lawyers.
Oh, my God.
We can't do that.
This is morning television.
It's a fictional play from like 1,000 years ago.
Yeah.
No, I think, one, just context, right? So I don't mean to talk so much here, but remember, our regulatory system is state-based. So we have 50 regulators to interface with that really set the rules for anything from a product side or a solvency side from the industry. So there's not one jurisdiction or the federal government that we could go to and say, hey. But there are some proposals on transparency when third-party funding gets involved with litigation. People are looking at rules of civil discourse to maybe change how federal courts might interpret, certain aspects of litigation. So it's not like we can't do anything, Katie, but it's a complicated problem that has a powerful lobby on the other side.
Chris, did you have another social inflation?
Well, I just want to say,
switch gears a little.
Well, no, my dad's a lawyer, first of all, so I don't really mean to kill all the lawyers.
It's an important context.
But one of the things he often says is AI is making his work a lot easier. And Google said AI wrote a quarter of their code in the last quarter. I thought it was shocking. What is AI able to do for you at Hartford?
I would say in the AI definition, currently I would say it's data science. So we've been rich with data for decades as an industry, and obviously we've been able to organize it in a way that helps us underwrite more accurately, more timely, and ultimately then pay claims more thoughtfully and timely also. The generative AI or the artificial general intelligence wave, I think will ultimately help our employees with a better customer experience. So we're running our experiments, we're deploying it with aggressive passion, but discipline at the same time, because we really do think it'd be a game changer, particularly for employees when they have more information, because ours is a technical business. When they have more information at their fingertips and could have that more intimate discussion with customers and really empathize with them, I think that's a game changer.
Chris, I have an inside baseball question for you. A little earlier this year, you had seen Berkshire Hathaway take a very, very large stake in a rival firm, Chubb. They are one of the top 5 holders, and it set off a wave of speculation within the industry. Does this mean there's more consolidation ahead? So I pose a question to you. Do you think that this is an industry that is just set for mergers and acquisitions? And what role would you play?
Yeah, I would say not necessarily. The simple answer is I still think it's a good time to be a property casualty insurer. We have a good group benefits business also. But when the times are good, you still want to operate independently, make money for your stakeholders, your community, your employees. So very few people, when times are good, think about M&A. It's when things get a little rough, growth is a little slower, loss cost trends maybe are exacerbated, that maybe some organizations may think in terms of M&A. But M&A is a low priority for us. I've been pretty consistent in saying that. I think organic growth and all the product development that we've done and all the investments we've made in our organization is really differentiating ourselves in a competitive marketplace.
It's a high priority for Sonali, just so you know.
It's because I'd like to break all those
Always
deals.
trying to break news. Chris, great having you in the studio. I hope we can get you back in here. Chris Swift there from the Hartford talking us through the insurance business. Coming up, Tony Award-winning Broadway producer Daryl Roth discusses what it takes to get a play from its initial concept onto the big stage. This is Bloomberg.
Time now for our daily Wall Street Week conversation. And more than 12 million people attended Broadway shows last season. But what goes on behind the curtain? David Weston spoke with Broadway producer Daryl Roth about the hard work and the financing it takes to get a play on the stage.
Well, you try to be frugal in ways that you can. There's certain things that cost what they do. But you try to be careful and cautious about advertising dollars and where you're spending the money, so that if you need the money to keep the show running, if you don't come out of the gate with gangbusters, the main objective is keeping the show running long enough for the word of mouth to carry and to really give yourself a good opportunity to be successful. So you have to be very careful about how you spend your money. And I think I'm mindful of that. So that's important. And then back to how do you structure it. Usually you pull together a group of co-producers that will enter into the capitalization at a certain level. And those people are going to be named in the title page, and they'll be part of the meetings if they choose to be. Some people just want to be there in name, and that's fine. And other people want to actually get involved and help you. And then the next level will be investors that come in without any billing, without any title, but they just want to help birth something and get excited about being part of producing a new work or a revival or a tour across the country. And so those levels are determined by the producer. You know, I mean, without being too specific, usually an entry in a play for a co-producer would be somewhere between $150 and $250. And usually, in my experience, and what I've always done, my unit prices are usually $50,000. So a person can come in and invest, not necessarily be a co-producer and be part of it. You know, and for that, they're invited to opening nights and, you know, get the joy of being part of something.
Do you have a pro forma budget that would include how long you expect the play to run?
Well, yes, because in many cases, plays are limited engagements. Left on 10th is a limited engagement. So we're beginning our previews in September, and we run through the beginning of February. So we have to make our numbers work within that 20-week period. And so we have expectations. We have marks we need to hit in order to hopefully get to recoupment. And that's what we look towards. I mean, many things don't recoup in New York, but there's always a beautiful afterlife. You know, plays go on tour or they play different cities. They're licensed and can go around the country, regional theaters around the world. Kinky Boots, for example, is in Korea for the 4th time, and it plays all over the world. And so, you know, although we did recoup many, many times in New York, but sometimes you have to wait for the afterlife to see your money return.
You clearly love what you do, for the pure joy of it. But how do you judge your success?
I judge my success by saying that theater deals in a different currency. It's not always about the money, although some people will say it's always about the money. Of course, I want to be responsible fiscally to my investors. Of course, I want to see a return of capital. But I think my heart, first and foremost, is in presenting work that's meaningful and thoughtful and could change minds and give people, I don't know, just hope in life and just give them the opportunity.
And that was Tony Award-winning Broadway producer Daryl Roth. And David Weston joins us now. Really interesting conversation on how plays get made, what the financing looks like. Daryl was saying that her unit prices are usually $50,000. If I invest $50,000 into a play, what do I get back?
Well, you get a participation in the profits, if there are profits. I mean, you heard her refer to Kinky Boots because she did, in fact, produce Kinky Boots. So people who invest in that made a fair amount of money. But one of the things that I thought was interesting, I did not know, is by and large, we talked to also one of her backers who explained this to us. They do it almost like an investment fund. It's not necessarily for one play. They do it for a series of plays. And she said, although you won't necessarily get rich off of this, she does make money over the whole run of the plays that she invests in.
I was just going to go there.
Yeah.
What do the investors in the industry say as well? What are their return expectations? Do they do this for the love of the game?
Well, the woman I spoke with had a very successful career at Goldman Sachs, actually. And after she stepped away from Goldman Sachs, she said, boy, why don't I get involved in this? I sort of like the theater. And, you know, it's a double bottom line, as they say. You know, on the one hand, they do want to make some money if they can, but they also just love participating in plays. And Daryl Roth, who's very well known, by the way, her husband owns our building. I don't know if you know that. It's like Fort NATO. That's Steve Roth. That's Daryl. But she's been very successful. And she also wants to put on plays like this Left on 10th, which is the Delia Ephron sort of memoir that has a larger social meaning, that you take something away from it that has some meaning to it.
I wonder what the hottest ticket is right now? I mean, what's the Hamilton of Broadway these days?
Well, I'm not an expert on Broadway. I'm not sure there is a Hamilton right now. I think that Our Town is something that everybody wants to go see right at the moment. I think that's the new one that people are talking about. But Left on 10th has opened now, and Sherry and I went, and it was terrific. It was terrific. It's Peter Gallagher and Juliana Margulies, and so there are a couple of big names, and it's fascinating. It's Delia Ephron's story of her life.
I thought you were going to say, what's the NVIDIA of Broadway right now? If you think about plays as an asset class, it's kind of.
I mean, Hamilton would be the NVIDIA, right?
That's true.
If you invested in Hamilton, I know someone who did, and he just bought, a trove of tickets when it started and made a ton of money on it.
There you go.
David, great conversation, really interesting stuff. David Weston there. You can catch Wall Street Week every Friday at 6 p.m. Eastern. And by the way, we'd love to hear from you. We'd love to hear what you think about our shows here on Bloomberg Television. And you can give us your feedback. You can be part of lining the day here. Just scan that QR code at the bottom of your screen and take our survey to give us your take on BTV. And do you think we're doing well? Do you think we need to change some things?
Do you like Matt Miller?
Yeah. Should I wear a wig on a regular basis?
Please write that in.
This is Bloomberg. We are just 5 days from an election, November 5th, obviously. Both Donald Trump and Kamala Harris will be spending their Halloween in the Sun Belt. Harris will head to Nevada and Arizona, while Trump will also be there, adding a third stop in New Mexico. Joining us now is Joe Matthew, co-anchor of Balance of Power. He's in Washington, D.C. And, Joe, it seems like garbage has taken the spotlight. I did not expect the Trump campaign to go so big with us, but they found a truck and actually painted it MAGA. What's the story here?
Sure did. Drove around the parking lot for a while, let people take pictures of it. And as you can see on Bloomberg TV right now, Donald Trump donned the whole orange reflector vest regalia in an attempt to, I guess, look like a garbage man. A pretty interesting optics to have, for the second time in a month, a multi-billionaire dressing up as a shift worker. First it was McDonald's, now it's the garbage man, and this all comes back to what Joe Biden said the other night. This is really getting to be like several shades here in the silly season with 5 days to go. It started at Madison Square Garden, the joke about Puerto Rico being a floating island of trash. The Harris campaign made a big deal out of it, and when Joe Biden was asked about it in a Voto Latino event the other night, he seemed to imply that Trump supporters were garbage. He clarified that remark. He said he didn't mean it that way. He
seemed to imply. He just said it straight up.
Well, hey, listen, the power of the apostrophe, you can work that out with the White House. But the Trump camp saw a huge opportunity on the eve of Halloween. Dress him up like a garbage man.
Yeah, exactly. Of course, getting Halloween started early with that costume, cosplaying, if you want to call it that. Let's talk about the polls. Of course, we are 5 days away. There's a lot of focus, particularly on the battleground states, in addition to the national polls. What are we seeing when it comes to the likes of Pennsylvania, for example?
Well, it's just so close that nobody can call these. We did get new numbers today, for what it's worth, from UMass Lowell and YouGov, and it's the same pretty much that you see everywhere else. Pennsylvania, they've got a 1-point race. Harris up 1, 48-47, so we call that a tie. Michigan, Harris up 4, 49-45, pretty close to the margin of error there. And when you look at Wisconsin, when you look at the other swing states, this race is too close to call, unless, of course, and these can both exist at the same time, the sample is not reflecting the current electorate, knowing that we've gone through a lot of changes over the past couple of elections, and there are questions about whether pollsters are reaching the right people. I will add the early vote, which is raising a lot of questions about turnout in the end here. Pennsylvania has been at it. A lot of states have been at it here. In fact, when you look more broadly, remembering in 2016, we had 40% overall turnout was the early vote. During COVID, that went up to 70%. It looks like we're going to be somewhere in between the two here. So well over a third of Americans, imagine, as we talk about the garbage man routine, they've already voted. This doesn't matter at all to them.
All right, Joe Matthew, really appreciate it, of course. 5 days left. Balance of Power co-anchor Joe Matthew is all over it. And on Tuesday, Election Day, Joe and Kaylee Lyons will have a 2-hour Balance of Power special to kick off our election night coverage, followed by Bloomberg's Election 2024 special. That begins at 7 p.m. New York time. Before we get there, though, let's take a check on these markets. Of course, in the thick of earnings, more to come after the bell from big tech. You can see pretty bad backdrop. I'll just come out and say it. The S&P 500 really taking it hard. Of course, those misses that we got last night, down about 1.5%. Big tech in the spotlight, under the microscope right now when it comes to AI spend. The NASDAQ 100 down about 2%. We'll see, of course, what Alphabet, or not Alphabet, Amazon and Apple can deliver, whether, of course, that will actually change sentiment at all.
Yeah, but those will be after the bell. So if we have a loss of 0.9% or more, we're down for October.
Shocking. But, you know, November, you'll see after next week whether we finally get some of the risk-off tone out of the market.
All right, coming up tomorrow on Open Interest, it's our Jobs Day lineup, including Acting Labor Secretary Julie Su, BlackRock's Rick Reeder, plus an earnings conversation with Chevron CEO Mike Wirth. You don't want to miss it. This is Bloomberg.